Hey everybody, this is Ryan Mallory. We're going to talk about coronavirus stocks, Amazon, Netflix, Zoom. Should you be buying them during the stock market crash? Is this the time to get long, or should you just stay put? Let's go ahead and get right into them. First up, Netflix. This thing's been on an incredible run. We're sitting at all-time highs. It's over $426 a share. Do you buy it here? No, you don't buy it here. Definitely don't buy it here. Why? Look at this rising channel here. It's held onto it really well. It did dip below it during the initial fallout from the coronavirus, and now it's just seen unfettered buying, just constant buying. And the people that are getting into it right now are not the smart money. It's the people who are buying it out of the fear of missing out. You don't want to be one of those people. Everybody's hyped up on Netflix and Amazon because Mark Cuban bought them, and those were the two stocks that he bought during the downturn. Now everybody's trying to play catch up. Look, you can't be like Mark Cuban after you're weeks late to the game. The stock initially broke out above this purple line here, and now it's at the upper end of this rising channel. Who knows? Maybe there's more reward to the upside. I don't know, but guess what? The risk is far greater than the reward at this point. What do you expect at this time? To go up to 500 a share? It didn't do it during the best of times. Maybe it does, but we've already seen the potential of how it can go from $390 all the way down to $290. It can drop $100, so the risk reward is not there for the trade. Let it come back. If it doesn't, go on to the next trade. Let's look at Amazon. Again, is it worth buying? It's done great in the coronavirus atmosphere. People are buying to it because that's how people are doing a lot of their shopping right now. Instead of going to stores, mom and pop, or going to department stores, they're going to Amazon. There's a lot of hype. There's a lot of FOMO. They're buying because they fear of missing out. But look right here. There's a huge resistance level right overhead. It touched it today. It's touched it before. Previous times where it's tested that resistance level, it has pulled back dramatically. Going back to December 2018, it pulled back pretty hard. Going back to May of 2019, did the same. Pulled back for a solid month. Again in July. Didn't even quite get there in February before it pulled back due to the coronavirus, and now we're there again. Odds are there's much more risk to the downside at this point than there's to the upside. Maybe it gets to 3,000. Okay, that's a $700 move on a $2,300 stock. Pretty good, but there's also the possibility that it pulls back to this long-term trend line going all the way back to 2016. And if it does that, that's about a $600 pullback. So you're willing to risk $600 of downside for $700 as upside? If I'm going to take something that has about $700 of upside, I only want something that has about $200 or $300 of downside at most. Now you take Zoom here. This thing was loving the coronavirus before anybody knew what the coronavirus even was. February, this thing started taking off after being very dormant for the previous 3 months. Now we're sitting right there, right below all-time highs, and it's looking like it can make a move above 165, 170, but the key here has always been to buy it off of the 50-day moving average. If it does that, it gives you a better risk reward. After it's made a $40 move in the past week, I don't think that that's really the time to get into a stock after it's made such a dramatic move. Let it come back. So here's the thing about stocks like Zoom, Amazon, Netflix, Clorox. When they go up like this, there's eventually going to be a moment of profit taking. And that's usually when they're the most hyped, when they're the most exciting stocks to be in at the time. That's when you start seeing the street take their money out of the trade. And that's when they're going to leave Trader Bob holding the bag while the big money gets out. But speaking of Clorox, let's take a look at that chart too. Because this one's been very volatile. Yes, it's steadily rising, but in the meantime, there's a lot of up and down action, and that's not really what you want if you're trying to ardently manage the risk on trades. Look, this thing's gone from 156 in a matter of a few days up to 215, all the way back down to 160. That is very easy to get messed up on one of these trades if you're buying in at a 190, 200. Maybe this thing goes from 195 to 300 at this point. Nobody knows that. No one. However, the optimal times to get into it is when it comes back down to this 200-day moving average, because if you look at the 200-day moving average, it has consistently bounced off of it. Maybe you could even make an argument for the 50-day moving average, but there's more downside if you get in at the 50-day. Here's a stock that has a lot of people really surprised because it's not really a corona-related stock, but it's really holding up well, and that's Advanced Micro Devices, AMD. Long-term trend line off of 2016 has held it perfectly. Perfectly. Hasn't broken it. Holding the 200-day moving average still, bucking its own industry that it's in, semiconductors, and continues to push higher. It broke out of this inverse head and shoulders pattern here. You have the left shoulder, you have the head, and you have the right shoulder. It's the opposite of a head and shoulders pattern, so it's kind of upside down. But it broke out of it. It broke out of it about 50.25, and it's been pushing higher ever since. Right now, it's also due for a pullback. I could easily see an opportunity where it pulls back to this 50-50 level, and then it goes right back up again. If it does, that might be a good opportunity to get long on it. But ultimately, anything that comes back down to this long-term trend line, I'm kind of digging it. It looks really solid so far. And that doesn't mean that it'll always hold. There's no trade out there that's a guarantee. None. What you're trying to do is you're trying to find the opportunities that provide you with the best reward for the amount of risk that you're taking on. So if you're having to risk $50 per share on a stock that's only going to yield you possibly $25 per share, well, you're risking twice as much to get the $25. That's not a good risk reward. But if you're risking $50 in order to get maybe $150, then that's kind of a good trade setup. That's the kind of stuff that you're wanting to look at. But if you get into it at like 42 and it breaks below 36, that's about a $6 per lost share. However, to the upside, there's about $18 of upside, because if it goes from 42 back to its recent highs, there's not a lot of resistance there. That's about $18 per trade for the $6 that you're risking. That's the kind of stuff that you're really looking for. Finally, and I'm going to wrap it up with this. There's a lot of volatility in the market, both to the upside and to the downside. Okay, you're seeing 70, 80 point moves in the S&P on a daily basis. Sometimes you're seeing intraday swings of that much where it goes up and down and back up again. However, what I'm seeing a lot of traders do is they still get into very volatile trades. They're going after the Teslas. They're going after the Virgin Galactic, SPCE. They're going after mRNA. These are very, very volatile plays in a very volatile market. You don't have to do that. You want to go more for the quality, because they still have a lot of volatility, because the market has a lot of volatility. And when the market has volatility, that's when you really want to stay away from the small cap plays. That's really when you want to stay away from the very speculative plays. SPCE, that's a speculative play. Tesla, even though it's done really well over the course of the past few months, including the coronavirus, it's still a very speculative play. That doesn't mean that there's not a time and place to get into some of these trades. But if you're wanting to try to control the risk the best way possible, for me at least, I want to go after the more of the quality plays, the ones that have a little bit more stability to them, like your Apples and your Microsofts, your Adobes, and avoid the stocks like your Virgin Galactic or your oil plays that are very sensitive to price swings right now. You don't want those. They're appealing to the eye, I get that, but the detriment that they can cause to your portfolio and to your money, it's just not for me. In the end, it's not about the profits. That's why we get into trading. It's the wrong reason to get into trading, but that is why we get into it. But it should be because we want to manage the risk. It's not the sexy option, but that's the one that pays. Manage the risk, the profits will always take care of themselves. The profits are found in how you manage the risk. I'm really appreciative that you guys listen to me every time I post one of these videos. You guys really mean a lot to me. I appreciate the feedback in the comment section. Tell me what you think. Tell me what stocks that you're really wanting to buy right now. What one has the most appeal to you? And I'll try to do a video on those stocks as well in the future. Make sure that you like, make sure you subscribe. It really helps me to be able to put better content out there in the future and keeps the wheels turning. Thank you. God bless.